Hi, my name is Nurashki binti Muhammad Ali from B5G, and today I will present regarding company and group financial reporting. Before that, let me introduce my group members that will be presenting today, which is
Assalamualaikum. My name is Sayyidatina Umi Kalthum binti Said Umar.
My name is Siti Nur Nadia binti Ismail.
My name is Nurhuda binti Jamal.
Okay, first and foremost, let me explain what this question is all about. This question consists of one holding, which is Joy Berhad, and two subsidiaries, which is Rose and Heaven Berhad. And there is also one associate company, which is known as Night Berhad. In brief, let us continue on the percentage of acquire. Joy first acquired Rose on 1st July 2018 with the percentage of 30% and continued to increase his shares on the second acquisition on 1st July 2019 by acquiring another 30%, which now makes his control over Rose Berhad is officially 60%. Joy and Rose now have a parent and subsidiary relationship as Joy acquired Rose more than 50%. Next, on 1st July 2020, Rose acquired 70% ordinary shares in Heaven that makes Heaven officially subsidiary to Rose as his acquisition is more than 50%. At the same date, Joy also acquired 10% of Heaven, and that is for direct consideration. As for indirect consideration, Joy acquired Heaven for 42% and makes the total acquiring between Joy and Heaven is now 52% with the NCI of 48%. How did we get this 52%? It's coming from Joy direct acquire Rose of 60% and then Rose acquire Heaven for 70%. So, to make it easier, to find total indirect consideration, we take 60% multiplied by 70% and we will get a total of 42%. Then, we plus another direct consideration of 10% that makes the total of 52%. Joy acquired Night for 40% on 1st January 2021 that makes Night become associate to Joy Berhad. As for the NCI, since the question asks us to compute NCI using fair value method, so we took RM2.10 given in the question and multiply it by 320 remaining ordinary shares of non-controlling interest and we got 672 million. Continuing that, we include shareholders fund that consists of all of this. After that, we got the full goodwill of 451.1 million. Next, question B asks regarding the gain or loss on the mutual sales shares of Rose Berhad as at 1st July 2019. Just like the format given in the textbooks, we need to compare fair value on the previous acquisition and the carrying amount. As for the carrying amount, we need to multiply it by the percent of controlling interest. So here the percent is 30%, so then we compare 504 million and 378.9 million. Since the fair value is more than the carrying amount, we got the gain on sale of Rose Berhad of 125.1 million. Next, question C is regarding the goodwill or bargain purchase on the acquisition of Heaven Berhad as at 1st July 2020. So just like the previous, we put all the format in this table, but only a little bit different is we add on indirect consideration as Joy and Heaven has that indirect relationship. So, we need to take the percent controlling interest between Joy and the first subsidiary, which is Rose, and multiply it by the consideration transfer of Rose and Heaven, which is 420 million as stated in the information. As for this question, we got the goodwill of Heaven of 44 million. Question D is on the goodwill or bargain purchase on the acquisition of Night Berhad as at 1st January 2021. As I explained before, Night is associate of Joy Berhad. Okay, after we compute all of this, we got the bargain purchase of 29.40 million. This bargain purchase will be transferred to carrying value of investment in Night Berhad, and this carrying value of 306.10 million will then be transferred to SOFP as investment in Night Berhad.
Next, we move to the consolidated statement of profit or loss and other comprehensive income for Joy Berhad Group. For the revenue, we add the amount of revenue of Joy Berhad, Rose Berhad, and Heaven Berhad without having to apportion the amount since the acquisition of the ordinary share was made during the beginning of the accounting year. And then minus with 25 million because it was the intercompany transaction between Rose Berhad and Joy Berhad, where Rose sold goods to Joy Berhad. It was stated in the additional information 1. For the cost of sale, minus with 25 million due to the intercompany transaction between Rose Berhad and Joy Berhad, and then plus with 1 million due to the unrealized profit arise from the intercompany transaction mentioned just now. And then we minus with 2 million where it is the unrealized profit from the opening inventory of Joy Berhad. For the investment income, we eliminate the intercompany transaction, which is the dividend paid between the parents and subsidiaries. Next, for gain on disposal, we minus with 2.5 million where Heaven sold goods to Rose Berhad at a selling price exceeding the carrying value. And then we plus with 125.1 million as the gain on disposal of associate in Rose Berhad. For the amortization, it is the value of the internally generated brand recognized by Rose that have 10 years of useful life. As for the finance cost, plus with 0.25 million, where it is the interest from the 5% of redeemable preference share issued by Joy Berhad. And for the impairment loss, which is goodwill in Rose Berhad, we have to apportion it according to the controlling interest in Rose Berhad. And then for the share of profit of associate in Night Berhad, we calculate by multiply the profit after tax with the month it becomes an associate, and then with the percent Joy Berhad acquired Night Berhad. And then for the other comprehensive income, we just add the value as per stated in the question. Next, we go to the profit after tax attributable to the parents as well as NCI. To calculate the profit after tax attributable to the NCI, we need to calculate it every of the adjustment. For Rose Berhad, firstly we begin with the profit after tax of Rose Berhad, and then unrealized profit as additional information number 1, and then minus with ordinary share dividend paid from Heaven, and then minus with under depreciation building, which is during the acquisition by Joy Berhad. Next, we minus the preference dividend paid to Joy Berhad. And then we get the adjusted profit after tax. As well as for Heaven Berhad, we begin with the profit after tax, and then we minus with unrealized profit, which is stated in the additional information number 2. And then we plus with the over depreciation of plant, as stated in the additional information number 2, and then we get the adjusted profit after tax. Then we have to apportion it according to the percentage of NCI for each subsidiary. For the profit after tax to NCI for Rose Berhad, we need to plus with the preference share dividend and minus with impairment of goodwill. Then the balance of profit after tax after had been distributed to the NCI will be distributed to the shareholders of Joy Berhad. And then we calculate the total comprehensive income attributable to the shareholders of Joy as well as the NCI.
Next is question 1F. Question 1F is about consolidated statement of changes in equity for the year ended 30th June 2021 for Joy Berhad Group. In order to prepare the statement of changes in equity, we can use the schedule of analysis of financial statement. This is the schedule analysis of financial statement. And this is the statement of changes in equity for the Joy Berhad Group. As for the statement of changes in equity, there will be 5 columns to prepare the statement of changes in equity, including the group return profits, asset revaluation reserve, other components equity, and non-controlling interest. For the beginning balance for each column, this amount is from parents column in the question. Same goes to the return profit on asset revaluation reserve of Rose, surplus on revaluation, return profit on other equity of Rose and Heaven, and increase in the fair value of the investment. As for the new subsidiary is the amount of NCI of Rose and Heaven in the goodwill. 90 million is the NCI preference share of Rose Berhad. There are also the impairment of goodwill and indirect consideration Rose in Heaven. After that, in the column of group return profit, we have to minus the ordinary dividend paid and preference dividend paid. The total amount we get from the consolidated statement of changes in equity, we have to transfer this amount to the statement of financial position.
The last one I will explain on consolidated of financial position. As we know, in the bracket will be the submission of parent and their subsidiary, which is Joy Berhad, Rose Berhad, and Heaven Berhad. Property, plant and equipment. 0.5 is come from the depreciation of the plant, 2.5 is come from the URP Heaven, and 0.22 is the depreciation of the building. Intangible, the 50 million is come from the generated the brand and 1.5 million is come from the amortization of the brand. Inventory, 1.5 is come from the URP Joy and the 1 is the URP of Rose. Account receivable, 12.5 is come from the adjustment 1. 12.5 is come from the half invoice still not paid. Bill receivable, which is 6, is come from the additional information number 4. Loan due from Rose Berhad is eliminated because it intercompany transaction. Cash in transit is come from additional information number 3. Ordinary share capital and 10% preference share capital is take from the holding only. Meanwhile, the group retained profit, asset revaluation reserve, other components of equity and non-controlling interest is come from the schedule. 5% redeemable preference share is come from additional information number 7. Account payable minus 12.5 is come from the additional number 1, which is half invoice still not paid. Bill payables minus 6 is come from the additional information number 4. Loan due to the Joy Berhad is being eliminated because there is the intercompany transaction. Here is the close-up of consolidated statement of financial position as at 30 June 2021 for Joy Berhad's group. Question 2. Control is defined as the power to govern the financial and operating policies of an entity to obtain the benefits from the activities. When entity acquires over another entity, the acquirer is called the holding operans, meanwhile the acquiree is called as the subsidiary. An investor can identify if it is the parent by evaluating whether it has control over the investee. The investor has control over the investee if there is the power over the investee, exposure or right to variable returns from its involvement with the investee, and the ability to use its power over the investee to affect the amount of the investor return. Some situation, power arises from holding the majority of the voting right. FAR620 state that where the investor holds more than half of the majority voting right of an investee, the investor has power where the relevant activities are directed by vote of the holder of the majority of the voting right, or a majority of the members of the governing body that directs the relevant activities are appointed to a vote of the holder of the majority of the voting right. However, PISMA argument on the basis the ownership is not only the criteria in determining control is valid since there are still two criteria that need to meet. To have control over the investee, which is owing the investee ordinary share capital or more than 15% excluding the preference share, and control composition of the board of the directors of the investee company. Since robots does not fulfill the criteria, they do not have control over the MENA. FAR610 define relevant activities as those activities of the investee that significantly affect the investee return. Pertaining to the case, relevant activities involved were developing the product and manufacturing and marketing the product. Relevant activities directed by different parties which are developing the product by PISMA and manufacturing and marketing the product by robots. Besides, both activities significantly affect investee return, which is MENA.
Next is question 3. Question 3 is about FAI holds 80% ordinary share capital in Kush, meanwhile Cute and Sweet hold 10% each in Kush Berhad. Besides, on 1st April 2021, FAI Berhad disposed 50% of its ownership in Kush Berhad to Apple Berhad for a certain cash consideration. However, there is a contractual agreement with Cute Berhad and Sweet Berhad that allows FAI Berhad to hold a 60% of voting right in Kush Berhad even after the disposal. The question is whether under MFRS 10, the parent subsidiary relationship exists between FAI Berhad and Kush Berhad after the disposal. As we know, the parent subsidiary relationship exists if the investor have the control over the investee. After the disposal, the shareholding of FAI Berhad in Kush Berhad reduced from 80% to 40%. FAI Berhad has lost control over Kush Berhad but still obtained significant influence over Kush Berhad. Thus, Kush Berhad is considered as an associate of FAI Berhad. Nevertheless, MFRS 10 state that an investor can have power despite holding less than a majority of the investing voting rights, for example, through a contractual agreement between the investor and other vote holders. In this scenario, a contractual agreement between Q Berhad and Sweet Berhad permits FAR Berhad to control 60% of the voting rights in Kush Berhad even after the disposal. Thus, even after the disposal, its ownership interests, FAR Berhad and Kush Berhad, have a parent-subsidiary relationship. Next is the treatment of non-controlling interest. According to MFRS 10, a parent must present non-controlling interest in its consolidated statement of financial position as an equity, distinct from the equity of the parent's owner. Since the relationship of FAR Berhad and Kush Berhad did not change even after the disposal of 50% its ownership in Kush Berhad, then the non-controlling interest will be 40%. This is because there was a contractual agreement between Q and Sweet Berhad that permits FAR Berhad to control 60% of voting rights in Kush Berhad even after the disposal. This is the schedule how to compute the gain or losses of the disposal in share in Kush Berhad to be disclosed by the group. Based on this schedule, since the cash consideration is lower than the fair value of net asset on the date of disposal, times 50% of the percentage of the disposal, so we will get the loss on disposal equal to 31.6 million.
Based on question 4, since Clarity, Yang and Light Berhad decided to enter into a joint arrangement and they established a separate vehicle which is Dian Berhad, it is assumed that the type of joint arrangements are joint ventures. This form of joint ventures involve the establishment of a separate entity which could be a company, partnership or others. Since Dian Berhad is established as a joint venture, the share capital will be contributed by the venturers and the share capital in the joint venture will be held by the individual venturers, which will be disclosed in the separate financial statement of Clarity, Yang and Light Berhad. The venturers' interest in the joint venture is to be disclosed as a financial asset in their own financial statement, and it is to be measured in accordance with MFRS 139. In consolidated financial statement, the venturers must apply equity method in accordance with MFRS 128. That's all from us. Thank you.